Come on in, sit back and relax. You're listening to episode 256 of the WealthTech Today podcast. And I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features news, information, and analysis on the trends and best practices all around wealth management technology. My guest on this episode is Dr. Dan Rosen, CEO and co-founder of Digit. Now, Dan Rosen is not just your average co-founder. He's an internationally recognized quant and serial fintech entrepreneur. He's also an adjunct professor of mathematical finance at the University of Toronto and was the first director of the Center for Financial Institutions at the Fields Institute, which is also in Canada. Dan has worked with numerous financial institutions around the world, lectures extensively on risk and portfolio management, financial engineering, and fintech innovation, and has authored numerous research publications and holds several patents. Before founding Digit, a wealth management software company based in Toronto, Dan was the co-founder and CEO of R Squared Financial Technologies. Now, R Squared was an interesting company. They provided advanced risk and scenario-based analytics to traders, portfolio managers, risk managers for pricing, hedging, and capital management across asset classes. R2 Financial was acquired by S&P Capital IQ in 2012. Before R2, he started his career at Algorithmics, which was also a provider of enterprise risk management software to financial institutions. So a lot of work on risk and analytics in Dan's career, which he has used to great effect at his time building out the Digit platform. Now, we spoke a lot about Digit, of course, their platform, their institutional grade analytics engine. We talked about their UI. We talked about return metrics on derivatives. We got a little wonky and a little nerdy there. Talked about a financial engineering team, risk factor allocation tool, and of course, no interview would be complete for software about talking about integrations and their open AIs. So we covered all that. And speaking about risk management software, here at Ezra Group, we are experts on all wealth management software, including risk management, risk assessment, risk tolerance, and proposal generation, just to name a few. And one thing all these applications have in common is data. And it needs to be organized, stored, and managed so you can leverage it across your business. Otherwise, you're just wasting a lot of time and money. So when we start working with an RIA or broker-dealer, one of the first things we do is a comprehensive data assessment. This provides a top-to-bottom view of all the incoming data feeds and which downstream systems depend on them for successful processing and reporting. Now, this kind of data assessment is critical for any firm's growth plans since it's the foundation of building or improving your data warehousing solutions. So if you want to see your firm's data turned into an asset instead of staying a liability, you need to run, not walk to our website, EzraGroup.com, and click the golden Contact Us button on the homepage. The experienced team at Ezra Group can conduct a detailed data assessment, deliver targeted recommendations to optimize your existing data warehousing solutions, or put together a whole new cloud-based solution to help take your firm to the next level. You can schedule a free consultation by going to EzraGroup.com. And a few quick housekeeping chores before we continue. Please sign up and subscribe to this podcast wherever you listen to podcasts so you don't miss an episode. Please check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. All right, let's kick this thing off. All right, here we go with the next guest on the program. I'm proud to introduce Dan Rosen, CEO and co-founder of Digit. Dan, welcome to the program.
Thank you, Craig. It's a pleasure to be here today.
I'm glad you can make it, man. Where are you calling in from?
I'm calling in from Toronto,
All
up
right,
in Canada.
Canada. Love it. I haven't been there in years. I love that city.
Yeah, I love it. I've been living here now for almost 33 years.
Oh, fantastic. What do you like most about being in Toronto?
I love Toronto. Toronto's a great city to live in.
Mm-hmm.
It's definitely not the month of February.
Yes, the lake effect, the weather can be a little rough.
That's not, that you would be surprised, but love the summers. I love the city. It's multicultural, really cosmopolitan. It's beautiful. I mean, there's lots of green within the city, and there's a great tech environment and an industry today. So it's thriving. So it's a great place to be in.
Yeah, I've gone to Toronto a lot for wealth tech firms that we work with. It's great to be there. I love the downtown area. It's vibrant. You know, a
Yeah,
lot
yeah.
going on.
Absolutely, absolutely. Our office is downtown, kind of in the Soho side
Mhm.
of downtown, and it's a great area to be in. Very,
Excellent.
very.
All right, Dan, give us, for those who are listening, a 30-second elevator pitch for Digit.
So when we started Digit, we thought of building a leading enterprise wealth management platform that delivers scale and operational efficiencies to multifamily offices, to RIAs, broker-dealers, bank advisor networks. In the back end, we powered it with an institutional-grade performance and risk engine. Before starting Digit, my partners and I have been doing this for 25 years, and we built some of the top systems for hedge funds and institutional investors. So we brought in that institutional basically tech stack to put in a great engine that provides on-demand analytics, and the trick is they have to be consistently used across several integrated wealth management workflows. And those include reporting, billing, trading, compliance, and all the client engagement tools. And our goal from the beginning was to provide advisors and their clients with the best digital experience in the market. And we talk a lot about enabling firms to elevate the quality of the advice and to really be able to demonstrate the value to clients, to really show to clients and be able to answer questions and have all the information they need to engage with them.
Dan, there are so many applications in the portfolio management category. I partner with Michael Kitces on the Kitces Ezra Group Advisor Tech Map, and there's 33 applications just in performance reporting, portfolio management. And then performance reporting has got a bunch more, another 9 or 10. Yeah, you've managed to carve out a great niche for yourselves and be successful in this space. How did you do it? Why are firms selecting Digit versus the other 30 or 40 other applications available to them?
That's a great question. I think of a few things that makes us unique, and they were part of the goals that we set up when we started the company and we thought of what was needed in the market. So the first one is, and our client tell us, we keep hearing that. I think we really and truly have the best UI and interactive advisor platform in the market. It's fully integrated with client and portal and mobile, and really delivers a very modern, personalized digital experience to clients. We talk about getting advisors all the information they need at their fingertips so that they can have very meaningful engagement with the clients on the fly. To do that, as I mentioned in the beginning, we've built an institutional grade analytics engine. So we have great coverage. It's multi-asset, multi-currency, covers all the asset classes, including private equity and alts. But the trick is also to embed it into all these intuitive advisor workflows, as I mentioned earlier. Then that, with this analytics in mind, we can really provide a truly integrated enterprise platform. We talk about it as it being much more than just a reporting platform. It's a system to manage clients, to manage portfolios, and manage the entire business, driving all of these operational efficiencies and scale, which can be used by everyone in the firm, in covering all these very specific wealth management workflows of reporting, trading, billing, compliance, and client engagement activities. I think that to deliver that, we had the benefit. We started the company about 7 years ago, so we really built it with all the new tech stack. It's built on the cloud. We've never done on-premises installation. It's built from the beginning, and it's using all these very nice and modular architecture. It's designed for speed, for scalability, and with really nice open APIs that provide very easy integration to the client's tech stack. And the last thing we hear quite a bit, and this is not a product feature, but I think it is important and it links to some of our core capabilities, is we believe we have the strongest financial engineering team in the industry. We talk about financial engineering. So we're not only techie people, which we are, and we've built some great software tools, but we have deep finance, combination of finance, technology, and operations expertise that allow us to really understand the business of the client. So when we go into client engagements, we are not only thinking of how to deliver the system, but how is that going to impact the business and really provide a particular benefits to the clients as they're trying to solve their problems. I think those would be 5 key.
That's a good list. I like that list.
Yeah.
So one area I wanted to drill down on, and we do a lot of research in this area. And one thing that you mentioned that I don't hear a lot is the institutional grade analytics engine and risk. That's not something you hear a lot from portfolio management tools. So can you talk more about that? What type of hedge fund investment banking functionality have you built in the past that you're bringing now to advisors in these and embedding in wealth management workflows?
Yeah, so before we started Digit, my two partners and I, we've been working together for now over 25 years. This is our third company. We started early in the mid 90s with a company called Algorithmics. Algorithmics became the largest enterprise risk management software company in the world at the time. We had, 75% of the top investment banks in the world as our clients. And eventually the company got acquired by Fitch, went to IBM, became IBM Risk Analytics. And actually IBM just a couple of years spun it off and went into SS&C, so SS&C Risk. And it's still a prominent part of the SS&C portfolio today. When we first sold the company, my two partners and I left and started another company called R Square Financial Technologies. And in R Square, we built a multi-asset portfolio management system for institutional investors, hedge funds. At the time, there were systems for equities. There were two systems for fixed income. There were no systems for credit, but then everyone started to trade credit. And then we had a huge crisis with credit, and we had a system that knew how to do credit. So actually, during the financial crisis, we grew quite a bit. We got some of the top hedge funds in the US as our clients. We had the UBS DAP fund. We had Canyon and Ares and various of the top hedge funds in the market, and we grew quite a bit through the crisis. We got acquired by Standard & Poor's. At the time, we integrated with our Capital IQ platform. I led the risk analytics group there for a few years. And then about 2016, we decided to go and try again. And we started Digit with the idea that there was this huge opportunity moving into the wealth management space. And really wasn't even our idea. It was, we had a couple of hedge fund clients at the same time and independently telling us, are you talking to the wealth guys? Are you talking to the multifamily offices? You have no idea how much what you're doing could help them. If you could just figure how to make it a little bit easier to use, how to put it into their reporting workflows, into their client engagement, you have no idea how that's needed. So with that in mind, we started Digit, and really, I went and talked to anyone that I knew and had contacts in the with advisory firms, particularly RIAs, and actually I talked to also many of the bank and enterprise networks. And yeah, we had an amazing reception very, very quickly on, and we managed to start the company. We got 4 early adopter clients before we had a product. We had investors coming in, and that's when we knew we had something that was definitely out there as a big need.
Can we talk a little bit more about some of the specific asset types that your system supports with this institutional grade analytics engine? Talk about private equity and why it's important for some firms like family offices or high net worth RIAs to have that visibility into private equity, and what benefits do you bring with that data?
Yeah, and a very important point that that you started the question with. So I want to highlight it and then move into private equity. I think the key point is that you need to have a multi-asset platform designed from the beginning, thinking of financial instruments in very generic terms, whether it's equities, fixed income instrument, maybe commodities, maybe derivatives, private equity investments, etc. Right? So the general concept of a financial instrument, which is able to have a value at a point in time, generate some cash flows, or requires some cash flows is a very generic thing that you need to design from the very beginning. You can't do it as an after the fact thing. The same thing as doing a multi-currency component. You need to have the concept of a currency embedded in there. So from the very beginning, we thought of using that because really almost because we didn't know any better. That's exactly how we've been building systems for the banks. And so for me, it was the obvious way of doing it. There was no other way of doing it. So from the very beginning, we defined it in this particular way. One of the things we found very quickly as we went into the wealth space is particularly going to the multi-family space, office space, which is a big part of our client base today, and we've been very successful in that space, is this multifamily offices invest quite a bit in specific vehicles like private equity investments or private equity funds, credit funds, hedge funds, et cetera, right? So when you think about this, it's not an equity. It's not something that you just have a value for and you just put it there and maybe it has a book value. Private equity investment has various capital calls and redemptions. It has locked-in periods. It has different things that you need to model very accurately if you want to understand. And therefore, the analytics that come from it are also different, right? So what is the return on a private equity investment? Well, I would ask the question, return on what? On committed capital, on deployed capital, et cetera, right? So everything that comes and all the different cash flows have to be modeled in great detail. And therefore, the analytics that you put in there also have to account for understanding all of it. So a big important thing, for example, for many of our clients is not only to have a value and to be able to aggregate them, but also to be able to understand all the cash flows requirements, right? So when we'll have some forecast, for example, of capital calls to make sure that the client has enough cash in their cash account or be able to ask for them in advance, or locked in periods, understand liquidity, when that money can or cannot be taken out, as another example.
Right. So that leads me to the next question about liquidity management. Now, that's not something that normal wealth management systems handle, right? It's very different saying cash flow versus liquidity management. They're two very different requirements. As you mentioned, with PE investments, you have very complicated cash flow requirements, as you mentioned, committed versus deployed capital calls and such. Can you talk more about how that liquidity management works and how do you link it to the client's goals?
Yeah, no, this is definitely one of my favorite topics. This is something that has been almost my pet
I'm glad
peeve.
I asked you about it. Good thing you're here on the podcast, Dan. Let's talk about it.
Yeah, no, seriously, I've when we started and I've been doing some research on multi-stage optimization, which is one of my area of expertise for a long time. Always the personal investment problem is a typical problem that comes from that, and it reminds me a lot of an asset liability management problem that a bank would have on their treasury, right? So you have a bunch of money that comes in, which might be money that a given family might be able to invest periodically in there. Once in a while, maybe there's a sale or something and there's some cash flow. So there's some assets coming in that you want to invest the best possible to meet some liabilities. And the liabilities might come from some of the investments themselves, as you would have on the private equity side, like you might have a capital call, or you might have something else, or typically they come from goals that a person or a family sets in. I want to buy a house by this point in time, or I have 2 kids that I'm going to have to send to university. I just finished with my kids on that, so lucky me. But for a few years, this is a substantial cash flow that you need to be planning for. And then there's, of course, the whole accumulation time when you retire, that you're going to need a certain amount of money to live your particular style of life in particular ways, maybe to travel, maybe to live for charity, or for your kids, or help, whatever. So that is in the end an asset liability management problem. That goal-based wealth management requires actually, to do it well, a sophisticated liquidity management system. It's a liquidity management problem. Like, how do you actually plan from all your assets to be able to meet all your liabilities and then have some, right? So that to me is a key thing. So from the beginning, when we thought of the problem, was whether it is bringing private equity investments or whether it's fulfilling a given goal, you should be thinking of being able to project cash flows and under multiple scenarios, because you don't know what the world is going to be doing. So you need to be thinking about it in some probabilistic terms, and then being able to just say, how likely is it for me to meet those goals, or what do I need to do to make it very likely, or to be 100% sure that I can meet a certain goal, that I can meet a certain liquidity constraint or commitment to an investment. And that is a generic problem. And from the very beginning, we've built an engine, and we keep on working. This is one of the areas we've been working very, very actively over the past few years to try to develop that liquidity management tool.
It's very cool. I see the tremendous benefits of having that type of engine built in, or that type of module built into the platform. Well, are there any other areas when it comes to liquidity management or liquidity constraints that you've been able to integrate that you find beneficial to your clients?
Yeah, so on the private equity side, we've been working quite a bit to build everything to do with the ability to do cash flow projections for calls, etc. To have some liquidity metrics on the ability of when the money can be made available. So have some liquidity metrics of that allow advisors to have meaningful conversations with their clients when their different amounts of capital might be available to doing different things, or what they can do to change that. We've been working quite a bit on return calculations and return decompositions. So the ability to provide a completely integrated view of all investments for all their clients. So the idea of getting an integrated return calculation, but also the ability to decompose returns, both returns and risk in there. So a big part also of what we do is talk a lot about risk, the ability to give our clients some easy to use metrics of risk that are kind of going hand in hand with returns, with exposures, so that advisors can show their clients where they are at all points in time. One of the key tools we've been building for a while is a scenario engine, which is very, very cool, where advisors can really run a client's portfolios into the future. And they're truly forecasting ability under a bunch of typical scenarios. So for example, we might provide what we think of some crisis scenarios or some investment opportunity scenarios that match the history, but just say, what would happen to your portfolio today if something like that went to occur? So it's really making them forward looking, but getting some idea. So you can go and say, look, if something like, I don't know, the dot-com crisis, right? The AI might be completely overvalued. What happened in the dot-com crisis? Well, is it unlikely that NVIDIA could fall down 80%? I actually have heard quite a few analysts say things like that, right? So this is not something we haven't seen before. We have seen, and by the way, when that happens, there's also a recovery. So you can actually learn from history quite a bit, but you can go and figure out, What would happen to your portfolio? What would happen, and what could you do to maybe ameliorate that, or when that happens, to rebalance in the right way, to get clients comfortable with the investment plan over the long run.
And this is all integrated into the platform. I don't have to switch to another tab or log in somewhere else to get to this functionality.
Yeah. This is fully integrated. Some of it is I'm also talking about things that we're also deploying over the next couple of releases. But yes, it's fully integrated. It's part of our standard platform. One of the nice things, as I said, is we've built this. The idea is from the beginning to have this fully integrated platform that covers all of these very nice or important workflows.
Can we talk about the risk factor allocation tool? Of course, you mentioned risk. And how does that connect to the other parts of the system? And what types of benefits does it have for advisors who are using the platform versus using a separate risk tool, of which there are many out there?
Yeah, so typically most of the risk tools do, I would say, pretty simple stuff, because that's what most advisors want to do, and that's what most clients might want to do, right? So basically have a risk rating for a particular asset or for all different assets, and then have kind of an aggregated risk rating for a given portfolio, which in the end is just giving some mapping into a metric of risk. The typical metric of risk is how much money you could lose with a very, very small likelihood at a point in time in the future, right? So that's the typical thing. Now, I do want to stress that whatever is measures for portfolio risk are there, they don't necessarily map to what the risk is for your goals, because the risk for your goals is how far are you from meeting your goals, how likely it is for you to meet your goal. And if you are pretty far, you might actually have to take more risk, portfolio risk, in order for you to get the possibility of higher returns to make your goals. So that's just a little bit of a separate thing. But in the case of portfolio risk, what we've built is we have a really nice, and this is completely institutional grade, risk analytic engine using value at risk, which is the typical metric that hedge funds and asset managers use over a reasonable horizon. But the most important part is it's not the number that matters, it's how the number change and who's contributing to that number. That's really important, because the number, we probably can't measure it accurately. So if I tell you you could lose, I don't know, $50,000 with a 5% probability over the next year. So we can have a discussion, if you're my client, on, are you comfortable on losing that amount of money? It's a very low probability, but are you comfortable? But if I come to you next month and say, now your likelihood is 10%. Now whether it's exactly 5% or 10%, I'm not 100% sure. We're not that perfect to forecast.
It's the increase, the delta
increase,
between.
Yeah, so something changed. You have a more risky portfolio. That I can tell you. Now, if I can tell you why and where, it's because actually maybe you made more money on your equities because the S&P 500 has actually shot up, which means your allocation is now too big on equities. Now I need to de-risk you by rebalancing your portfolio. Now I've done it. Now, typically people do it by asset class, but hedge funds and sophisticated investors, for good reasons, which are good finance reasons, use factors, which are much more stable, much more explainable variables that can do it. So we can map any asset class to a bunch of risk factors. And some of the typical ones on the equity side are like momentum and etc. But the point is, you can really go and say, why is my risk changing? Where is it? Is it more concentrated? Where is it more? And if I bring a new investment, will that help me diversify my risk or not? And a typical example might be, you might be unaware of your real estate concentration because you have a bunch of, maybe a couple of real estate positions, but also a few positions in some indices or some funds which have some real estate or which have some other positions in real estate. Well, when you run it on a risk factor basis, those things come out right away. You would be able to see, oh, I actually have overconcentration on some real estate factor. And you could even break it down, because real estate is not real estate. There's commercial real estate, there's residential real estate, and they don't all belong. So you can really go and break it into the right set of factors. And as you bring in new investments, you can understand the diversification that they bring. So this tool that we build is very, very cool. It allows our advisors to break down their exposure, not only into asset class, but also into risk factors, and look at it from a risk perspective, and then be able to do some what if analysis to make sure that they understand if there's an investment opportunity or if there's a need for rebalance, how to look at it. Really thinking of diversification as the core concept that you want to do well with.
Dan, you have covered so much ground in such a short time, but now we are out of time. Can you tell everyone listening where they can find more information about Digit?
So you can find more information at our website, digit.com, and that's D1G1T.com. You can also please feel free to email us. You can email us at getintouch@digit.com, or please email me directly at dan.rosen@digit.com, and it's D1G1T.com.
You're a brave man to put your email address out publicly on a podcast. Thank you. Dan, you've been very helpful. A super interesting conversation. Thanks.
Yeah, no, thanks a lot for having me, Craig. It's a pleasure. Thank you.
Hey, it's Craig again. Here are my top 3 takeaways from this episode and my interview with Dr. Dan Rosen. Digit is a very interesting application, wealth management software company. They've got an institutional grade analytics engine, which is designed as a multi-asset engine based on their experience working with hedge funds and investment banks. They believe it's much easier to use with embedded wealth management workflows. It supports alts, including PEs, private equity, supports statistics and reporting like committed versus deployed capital. It can handle cash flow projections, showing you when money will be available based on the cash flows from your alternative investments. They have a risk factor allocation tool, which looks across portfolios and asset classes and supports what-if analytics. And of course, they have open APIs and a very robust integrated solution, which we appreciate greatly here at Ezra Group. Well, that's it. You've reached the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, please head over to our website, EzraGroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you receive an email chock full of wealth management, goodness, news, information, and updates. You will not be disappointed. Thanks again for listening. Talk to you all again next time.